Good morning.
Good morning.
Okay, just to be sure, we only have 2 persons in the class.
I see 5,
Okay, I may not
4,
be.
1, 2, 3, 4, Leah, Melissa, Janice, and me.
Okay, 1, 2. Okay. No, I'm just asking how many persons are in your class?
I'm not sure. I think it's about
Okay.
5.
Okay then. Okay, my name is Denise Dorset, and I will be taking you through units 10 to 14. And this is Trust Law and Administration 1, correct? Yes, ma'am. Okay, so just a review of your last unit. You know the role and responsibilities of the trust administrator. A brief overview. Anyone? This is from unit 9.
Well, I guess the trust administrator basically runs the day-to-day activity of the trust.
Mhm. Under whose direction and oversight?
The trustee.
Right. What about the law that as it relates to trust administration? What should the administrator ensure in accordance with the law? Anyone? Y'all went over unit 9 last week, right?
We did. I guess a few
Yes.
things. They need to be familiar with the trust instrument. They need to be familiar with all of the laws that are applicable to trusts and make sure that they're not doing anything outside of that. They need to manage the trust to the benefit of the beneficiaries, not doing anything untoward in that kind of way.
Mhm. Good stuff. And they should also ensure they have the relevant consent notices, beneficiaries being informed, timeliness of notifying the beneficiaries. What are some of the duties of the trust administrator?
They need to keep documents like accounting, minutes, anything that's related to their decision making. They need to keep them. on file. They need to make sure that they're protecting the property that they're trustee over.
Yes. Okay, well, hopefully you would have reviewed 9. I usually try to let you review the last chapter just as a refresher. So it's always helpful for us to start off the new unit with a review of the last unit. It helps you in retaining all the information required for your final exam. So it's always beneficial to you to engage yourself in the class in answering questions because it helps you with your studies as well. Let me take the register now. You can give me your names, please.
Leah Lowe is present.
Janice Stubbs,
Melissa Sons,
Lisa Francis is here.
Okay, so usually I ask you to read, I would ask everyone to participate in reading the chapter and we'll just go through it as you read. We'll just break it down. It's I find it a bit easier like that instead of you going, we just picking through what the chapter is. So when we're completed with this unit, we should understand the trustee's duty to account, the fundamental concepts of trust accounting, and the differences between income and capital, and the calculations related to both. Trustee's duty to account, who would be able to assist me with starting off?
I'll start, and I guess you could tell me when you want me to stop.
Yeah, so you'll finish at trust income.
Okay, sure. Trustee's duty to account. The trustee has a general duty to account for trust property. Additionally, the beneficiaries have a right to information regarding the status of the trust, including the trust accounts. Both the income beneficiaries or life tenants and the capital beneficiaries or remainder men require information on how the investments are made, capital is accumulated, income is generated, and the trust is being administered and managed generally. Trust
Okay,
accounts.
1 second. So the trustee has a duty, the trustee has a general duty to account for the trust property. So that's one of their general duties. They are required to provide the beneficiaries. The beneficiaries have a right to information in accordance with what section of the Trustee Act? Y'all know the section of the trustee?
Is it 83?
Yes, it's a section 83. They have a right to information regarding the status of trust, of the trust, including the trust accounts. And what are they provided as far as the trust accounts are concerned? Are they provided with the distribution information?
statements of account.
Right. So do I have to give them the statements on how I made distribution?
No, distribution is kept confidential.
Okay. And when they request these statements of accounts, am I to provide it to them free of charge, or I can charge them?
Free of charge, eh?
really?
They're entitled to that, eh? No?
No, remember it says that you could, remember in Lee Watson, you could charge them for the accounts?
Oh,
Oh, okay.
That's on page 23 of your book. You can find that. Production and receipt of trust accounts, as and when requested by the beneficiaries. They have the right to inspect trust accounts and demand information and explanations on them, but they're not entitled to demand copies of trust accounts unless they are prepared to pay for them. Okay, and so they have income beneficiaries who are now the life tenants and capital beneficiaries who are the remainder men. So the remainder men are the persons entitled after the income beneficiaries would have gotten funds throughout the life term of the trust or for a particular period. So who will consider a life tenant and who would consider a capital beneficiary in an instance where the trust is settled for the benefit of the children. However, the children are to get the house, but as long as the wife is alive, she's to get the rental. Who's the capital and who's the income in that instance?
So the children are the capital because they get the house after,
Right,
and because the wife is getting the rental income.
right. So she's the life tenant and they are the remainder men. So they are set up for both the income and capital beneficiaries, and you may provide them with information on how investments are to be made, how the capital is being accumulated, where the income is being generated, and the trust is, and how the trust is being administered and managed generally. So we as the trust administrators would be a part of the trustee, and they would have a duty to account in these instances. Any questions?
I guess I'm kind of puzzled as to
Okay, tell me
how
what it is.
how do they provide them with the information? I can't get a copy of as a beneficiary. If I want a copy of the statements, I have to pay for it. But so they provide me with this information verbally then, and my update.
No. You if you want to see what's going on, you would pay when you go to the bank, you pay for your statements, don't you?
Yeah, I mean, but I have the ability to get it online, and
Right.
they
I
do
mean, that's
mail it
only
to me.
here of late, but
No, but I mean,
beforehand, you paid for.
beforehand, then they would mail it, and then if I can't find that, then if I want an extra copy, I would have to pay for it. But I
Right,
would think
but
that if I'm entitled to information, I shouldn't have to pay
you
for
have a
it.
right to information.
Okay.
Yeah, you have a right to it. That doesn't mean that I have to provide you, and I may not, remember the trustee may decide not to provide you with that information. For what purpose? Why would they do that?
To protect
The contracts or
the
something.
integrity of what they're doing in terms of distributions.
Not only that, but it's protecting the trust because it may be detrimental that I provide a certain beneficiary with some information, eh? They may use
Okay.
it in certain places that it should not be. They may be an aggrieved beneficiary, so I may know that they're contentious, and I would try to protect the trust as much as possible by not providing them. So they may say, I have a right to the information, but I have made that conscious decision that this is contentious, and they can cause some problems for the trust. What problems they may cause if they get that information? What they can do with that information?
They could sue.
Sorry, I didn't hear you. You have a little feedback.
They could sue.
So they can sue, or they can provide that information to parties that would not be in the best interest of the trust to have a. So I may not, I may have a trust, and a lot of times what we say when people would have been sending for information on certain trusts, they go on a fishing expedition on a trust, but they don't, when they're asking questions as a general, if they're not specific, do we provide them with the information?
No, and I would say because a lot of times the premise of the trust is to protect assets through, not really, secrecy isn't the word I want to use, but through keeping it
So it's more
private.
like confidential and private. So it's a private vehicle that's being used for succession planning in most instances. So the purpose of you setting up a trust is to avoid the person's name out there, to avoid how the ownership may be structured. So if you know you have an aggrieved beneficiary or a beneficiary who really intends to harm the trust, you can withhold that information. And if they were to take you to court, you can provide the court with the reason as to why you have not provided that beneficiary with information. Of course, you would have to prove that there's some reason behind you not giving out that information. But generally, if there's an instance where beneficiary may be in the creditor's hands, yes, you wouldn't want them to have certain information, because you could put the trust out there to be liable for things where people can now search and say, let me see how I can get to these assets, eh? So they may be in the middle of a divorce and they may have statements that you don't want the other side to know about, because then the trust may be subject to litigation, eh? So there's certain things that the trustee still has a right. As much as the beneficiaries have the right to information, the trustee can decide whether or not they're going to provide them with that information in the interest of the trust, where it would prove to be detrimental if they got that information. Was that helpful, Ms. Stubbs?
Yes, yes, it was. Thank you.
So sorry, I'd
So-
like to go back to that just to add.
Uh-huh.
So in terms of charging, it would be wise, I guess, for the trustee in the trust instrument to actually include some information in terms of maybe even from the outset to include in their trustee administration fee charges that would cover producing statements, or add something in to say that statements of a certain kind could be made available, or is that not really common to be done?
No, because you would say that's disbursement, say like, you would say that's a charge that will be attributed for you get anything that you would have asked for. You wouldn't expect that the trustee will just provide that to you. There's some service fees that come with that, eh? So if I'm calling up a trustee, they're not just at my beck and call, eh?
Okay, that makes sense to me, because even when I think of in terms of a bank, if I have a bank account, I'm paying the bank fees in any event. So in
Right,
my mind, a part of my fee is the production of statements.
right. So as much as it is, and separate and apart from that, you as a beneficiary, whilst you have the right to this information, I am not a trustee who have to provide that to you unless you ask for it. So the fact that you have to ask for it should indicate that that you asking for something means that is outside of what I have to do on a daily basis. So that's not envisioned in my fees, obviously, eh? So when you request it, then you should be prepared to pay for whatever you request outside of what I have to do, because it's not a part of me doing what I have to do on a daily basis, more or less. So a part of your banking, your relationship is, remember now, this trust is not established by the beneficiaries. It would have been settled by the trust, by a settlor, eh? With these beneficiaries in mind. So now they are now aware of being beneficiaries, either by communication from the settlor or otherwise. And when they come to be aware, they may now request information. But remember, we didn't have them in our contemplation when we began to say that we're going to be providing you with statements on a regular basis. Now, if that's a part of your initial setup or an agreement you would have made on establishing the trust, that's a difference. But if it's something that they requesting outside of what you had envisioned, then of course, you can charge, it doesn't say you must, you can charge a fee. Because some private bankers may not add fees to it, especially where the beneficiary may be sui juris, and they are able to, they have control, they're fully vested in the trust. Because what may happen if I am a beneficiary who is sui juris and fully vested, what I may do?
You could request that the title is transferred to you so that the trust could be terminated.
Okay, so then I will lose that business, eh? So I will handle them differently now, wouldn't I?
Yes.
Right, so all of these factors come into play. Okay. Anything else? Are we clear?
So you only provide a statement once the beneficiary is requested. It's not in your duties to provide timely statements at a particular time?
Not unless we have that set up at the outset, eh? Because remember, we may decide, you know something? I may not want to give this information out there. Now, it could be a case where the beneficiaries may be receiving income. So they may need these statements for them to, if they're in a tax jurisdiction, they may have to provide proof of how they get their income. So that may be an obligation under the trust. But I'm saying if it's just outside of the regular course of business, and it's nothing that I need to provide to you unless it's absolutely necessary, I don't have to provide it to you. And I may already have been, I may not be a trustee who wants to charge you for those statements. I'm saying they can charge, they don't have to charge. It's their discretion as to how they handle their client base. So it may be that I want to appease my clients and I don't want them to feel like I'm nitpicking and charging for everything. So by all means, when you request something, I may provide it to you, provided that it is not detrimental to the trust. But I may be required to provide you with statements based on the fact that you're receiving income from me, and you have to report the income, and you would have to show proof as to where and when you receive the income and where you're receiving it for, what you're receiving it for. Yes?
Okay, understood.
Okay, so let's continue, please, Miss Lowe. I think you're having.
Yes, ma'am. Trust accounts often comprise the capital statement and income statement and represent the accounting of the income and capital within a trust and the decreases and increases to such income and capital for a specific period. The period for which trust accounts will be made is dependent upon the particular accounting year that the trustees elect. Although the accounting period may be traditionally set to coincide with the anniversary of the date in which the trust was originally created. The trust period may be set for a particular period in which beneficiaries may be required to make certain tax filings or prepare tax reports. Once selected, the trust period should remain fixed and ought not to be changed by the trustees unless authorized by the trust instrument.
Okay, so we have the accounts and they comprise of the capital statement and the income statement. Now, remember, we want to make sure we differentiate. So what is the capital statement compared to the income statement? We talked about it earlier. What we dealing with when we talking about capital for the trust? Because there's a difference, eh? Because we have two different beneficiaries, right?
The capital is basically who's entitled to the actual property, the trust property, and then the income is what is generated or the revenue coming from the capital.
Right, so give me an example of what would be on my capital statement.
let's just say a home.
Right.
In the deed, you were supposed to have the home given to the daughter.
Right.
And let's just say the mom is alive, but a part of the trust deed basically stated that the mom, until the mom passes away, then the home will go to the daughter.
Right.
So this home is this vacation home, and the vacation home is on rental in Exuma. And
Mhm.
so every time monies come in from the rental, it would go to the mom. I mean, it would go to the mom.
Mhm.
She will be getting the funds from the rental property.
Right.
And
So
upon the
on
death
the
of,
capital statement, the value of the home may increase, right? So
Yeah.
when we started out, the capital statement said the home was valued at 100,000. The home is the new statement you get. We have an appraised value because you should appraise your property regularly, eh? Not every minute, but I'm just saying you should know what the value of the trust portfolio is. So the trust period we provide in capital statement, we had stocks and bonds. We have a house. We may have jewelry. We may have an insurance that equity is accumulating on. So we may have stuff like that. And what we'd have that on our capital statement, and we'll show how it improves, eh? On the income statement, we'll have the income from the stocks, which is what we'll call the income from the stocks.
Like interest income or something like that.
The stocks, what you get paid on stocks.
is it dividends?
Yeah, so we'll
Dividends.
have dividends, we'll have the rental income, we'll have any cash value or whatever may come out of the insurance. So suppose the insurance pays us twice a year, we'll have that. If we had government bonds, the government bonds usually pay you twice a year, you'll get that, because that's a part of what? The income, eh? But the
Mhm.
capital, I just want you to put your mind that the capital stays put and the income generates and continues to generate, and you would get that over a period of time as the income comes in. Based on what? Because you only could get income after you would have done what? What goes along with income?
Appreciation, earnings.
So your expenses you have to pay out,
Stuff.
eh? So likewise, if we had any improvements on the capital, that will come out of the, if we had to improve the capital, if we had to make improvements on the house, does that come out of the income?
Yes.
Yes.
Okay, if we improving on the capital asset, the income beneficiary has to pay for that?
You mean like if they're doing a large improvement where it's going to increase the capital itself, like we're
Right, the
doing?
value of the
we-
house.
Okay, so no, because then that would be an adjustment to the capital.
Right. So we'll take that from the capital expenses, eh? We won't take that from the income.
So I have a question that might tie into this. Actually,
Mhm.
just wanted to go back. Sorry. If we have a home and say that one of the assets or the property going into the trust is a $15 million bank account, like
Right.
the money on the account is $15 million, and yes, it's interest bearing. And so my understanding is you would consider the interest of that income, but would that bank account be considered capital if it said that that bank account is supposed to be used specifically for the upkeep of the home?
Well, no, because you have to state how it's set up. So the assets of the trust are this house, the bank account, and whatever else, stocks and whatever. So we may set it up that this bank account, the money is for the benefit of the children. However, all interest earned from the funds are for my wife during her lifetime. Yes?
Okay,
Now, I can set up from the beginning to say, however, should the trust require funding, you can appropriate a part of these assets for the upkeep or for the purpose of the beneficiary receiving their life interest. So we can appropriate a portion of it. That's like if I leave a house for my wife to be maintained for the rest of her life, the income from the house. But now a hurricane comes and destroys the roof of the home. And to repair the house, it wouldn't make much sense. It just is in a decline, and they don't have the funds to repair it. So what happens then? It was supposed to be for the benefit of my wife, yes? And whatever remains is for the capital beneficiary, who's a remainder money. However, what can happen during the lifetime of that asset? It can be appropriated for the benefit of the life tenant, because the life tenant has the benefit. And the remainder money only gets after the life tenant would have benefited. So if my wife decides that, you know, something, I won't be provided for, I may have to sell this asset. They can consult with the beneficiary, the remainder money, to say that, you know, basically, I was supposed to be provided for life with this house. However, you know, it's been destroyed. I am unable to repair it, and I need to benefit from it. Do you have the funds to repair the house? No, I am a disgruntled child in any event. This wasn't my mom. This was my dad's wife only. I'm not repairing the house. So what can I do now as a life tenant? I will provide for myself. So I've already consulted you. You've decided not to. I may just go ahead and say, I need to appropriate this for the purposes of providing for myself during my lifetime. And I can get rid of the house if that's one of the options. I may have to seek some court intervention if necessary, but most of the time, they can appropriate the property if it's necessary. You know of instances in that where there's a testator would have left assets for a life tenant, in particular his wife, and she may have sold them all before the beneficiaries ever had a chance to utilize them, because she's still living. And when she finally died, all of the assets may have been dissipated because she said, I needed that to sustain me in life. So that could happen as well.
So I guess that's where the discretion of the trustees would come in to make sure that it's legitimate, but it also is beneficial to all of the parties then.
Right. So you as the trustee would now be making that decision. And you would have to justify it, of course. So you would make sure you have it minuted properly. And then you may also say, you know, something, I don't want to make this on my own. I may seek the court's assistance in making this decision.
So
Okay,
the
and then to go
remainder
back,
man has, sorry.
I just wanted to tie back into the original question of if you want to build on the capital that's there. So if we're talking about a house and the house is generating rent, which is
Mhm.
rental income, that income is strictly, that rent money is strictly to go to income, and it cannot be used to make improvements in the home? Or is it it can
No.
be used to make improvements, considered expenses, and then what's left after you approve the home is considered income?
Now remember, I am an income beneficiary. All the income is for me, and the expenses related there too. The house is the capital. That's your house at the end of the day. That's I don't have any legal title to that. So anything so that's just like we renting from someone. So as long as I was living in the house, my husband was here and he took care of all the expenses and I benefited from the income. So it may be, I may pay my light bill, I may pay for things that I may have affected, like I may have broken a window or a door. But for me to say I am repairing the roof because of normal wear and tear, that's not my issue. That's your issue as the capital beneficiary. That's your expense. I don't have to fix the roof. That's nothing to do with me. That's what you have to do. I don't have to paint the building. That's nothing to do with me. So it will be, you will look at it in the light of what are the expenses that would have occurred as a result of this, of you getting this income, but it won't be for the general, like improvement of the property. It may be for upkeep, like cleaning the yard. I may say that's an expense because you're living here. We have to do that, but not for me to paint the building and all that. That's something that I'm gonna keep in the future, and I want it to be at a certain, in a certain way, so I won't consider that as an expense from the income. I may want to change the windows from the regular jealousy windows to now hurricane proof windows. That doesn't come out of the income, because the income wasn't for the capital beneficiary. The income is for the income beneficiary. I really don't care whatever go on with this house. I'm not trying to improve it. I just living in here, or I'm just receiving the income. Now you can come to me to say, as a capital beneficiary, the trustee may say, now, in order for you to increase your income, we are suggesting that we make certain renovations. Would you be amenable to assisting or providing some financial contribution toward it? But if it's improving on your income, but it doesn't mean that I'm obliged to do so. Because then you would have only increased my share. I don't have to have that increase unless I wanted to do it. Then of course I can involve myself in that.
Okay, so then if in that instance, if you have stocks, for example, that are considered capital, you could sell off your stocks to make improvements to the home then?
No,
Or
no,
is
no.
selling the
Remember,
stocks considered
the
income also?
capital, right? The capital you cannot move because it's the income. Because the income beneficiaries have to get the income from that.
Okay,
Now you
Okay,
can move.
I have,
Did we say why you would remove the capital in the first, and why you would have to get rid of the capital?
I mean, if you're talking about making an improvement to the home,
Right, but then it should not come from somewhere else, because if it's only an improvement, then that's not really something that's mandated, or the trust cannot do without getting the home improved.
something in the instance of the life tenant becomes disabled and they're supposed to have access to the home, but the home isn't wheelchair friendly, then how do you make the home, which is the capital, workable for the person who's supposed to benefit from
So
it?
now it comes out of their income, because it's for their
Okay.
benefit.
Okay,
Yeah, so it's not for their benefit. We doing
Okay.
it, so it comes out of, that's an expense of the income beneficiary.
okay, got it.
Ms.
I have
Stubbs,
a
you were trying.
question.
Okay,
Yeah, there's normal wear and tear on a house, let's just say, and from time to time it would need major maintenance. It could be not a hurricane, but the roof could be damaged some kind of how.
right.
If why should I, the capital beneficiary, the remainderman, pay for that if the person living in the home or the person benefiting from it is going to reap the benefits? I mean,
Okay.
shouldn't it come from their fund, their side?
So more or less, what you're saying is, I'm not, as a capital beneficiary, I'm not gonna contribute towards the upkeep of the home. If there's
No,
any
I'm saying,
major, anything major, I will do it, but not as it pertains to if the roof is leaking, I'm not gonna repair that. That's what you're saying,
Right.
like more or less?
Right, right.
But if the roof is leaking, that's a major depreciation of the asset, isn't it?
Then, okay, let's just say the roof is leaking and I said, I don't want to do it. The income, the life tenant,
Mhm.
she has the right, he or she has the right to sell the property
No,
without the consent of the remainderment.
right, so what I'm saying is, I'm the life tenant,
Mhm.
and I had persons in there receiving income, or I am unable to live in the house anymore because it's not livable. The roof is leaking, the windows are falling out, the cement is cracking on the house.
Mhm.
I was provided a house for the remainder of my life. So if this house is not repairable, and I've come to you, or if it's repairable and I've come to you and you refuse to do it, I need a house. So what do you think
Or
I'm gonna do?
there might be no more, let's just say there's no money.
Right,
There's
so
actually no money.
right, so there's no money. I may have to sell the house and start to rent an apartment because all the trust said it was gonna provide me with a house for the remainder of my life.
Or
Now,
if
you
I
know,
sell the house, then the funds from the sale becomes the property of the trust, the assets of the trust, the sale proceeds.
right, but it now becomes, it becomes the property of the trust for the purpose of providing me with a home.
Okay.
Or it may become the property of the trust for providing me with an income now. So I may decide if I'm not living in the house, I may purchase another house with the sale of this house, because the house is a real expensive house. I may not be able to make the necessary repairs. The trust doesn't have the assets to do it. So this house may sell for 2 million, even in the state as it is in. And I may buy something of a lesser value with the funds, and it still is a capital for the trust, and I'm still able to live comfortably in the trust. Otherwise, I may say I'm gonna have to rent something, a house to for me to be in. And of course, it has to be at the standard that I was used to. But it would be more beneficial. The trustee may make the decision to say, you know what we'll do, we'll appropriate this property, sell it, and we'll now put the purchase something of a lesser value, but of some value comparable, and the person can now live in it. And the trust, as a result of me selling that, remember, that's not income for the income beneficiary, because the sale may be for 2 million and I only buy a place for $1 million. So now the value, that $1 million that's left, that's not income, that's capital. So that now goes back in as capital. That's income for the capital beneficiary and not the income beneficiary. The sale of the property is not the income, because it was a
Right.
capital, it was for the capital beneficiary only.
Okay.
All right. Any other questions? It's clear, it's becoming clear?
Yes, ma'am.
Yes.
Okay, let's continue.
You'd like to pick up reading again?
Yes, please.
Okay. Under the Trustee Amendment Act 2013, a trustee of an express trust must maintain reliable accounting records in relation to the following items: all sums of money received and expended in relation to the administration of the trust and the matter in respect of which such receipts and expenditures takes place, inclusive of all sales, purchases, and other transactions, and the assets and liabilities of the trust. Section 2 of the Trustee Amendment Act 2013 requires that accounting records correctly explain all transactions, enable the financial position of the trust to be determined with reasonable accuracy at any time, allow financial statements to be prepared, and include the underlying documentation, including invoices, contracts, and receipts necessary to facilitate the previous items in order to be considered reliable accounting records under the Act. Additionally, there is a documentation retention requirement for accounting records and any related documentation under the Trustee Amendment Act 2013. Trust account records must be retained for a minimum period of 5 years for an express trust. Failure to comply with this minimum statutory requirement will result in the trustees of the non-compliant trust being liable for a summary offense under the Act and punishable to fine not exceeding $2,000.
Okay, so we have the trustees now. Under the Act, they must maintain reliable accounting records. So reliable accounting records are which records? They are the records that explain the sums of money received and expended in relation to the administration of the trust, and the matter in respect of which such receipt expenditures take place, inclusive of all sales, purchases, and other transactions, and of course the assets and liabilities of the trust. We should be able to correctly explain all transactions in accordance with Section 2 of the Trustee Amendment Act 2013, and enable the financial position of the trust to be determined with reasonable accuracy at any time. Would we talk about saying where the financial position of the trust is? How would we determine that? By valuation, eh?
Can you repeat your question, please?
How would we determine the financial position of the trust? We should be able to enable to be determined with reasonable accuracy the financial position of the trust. How do we determine that?
I guess looking at the difference between assets and liabilities.
Right, but we have to make sure they are valued properly, eh?
Properly. Yeah, so make sure we have proper valuations and appraisals
Right.
and so on.
Right, so we shouldn't be using a valuation from last year to say that this is the accuracy of the financial position of this trust at this time. When we doing the accounting records, we should have some accuracy on the financial position of the trust. We should also have financial statements prepared. Who would prepare these financial statements?
An accountant?
Yeah,
The
so if
trust
it's not
accountant?
done by an auditor, you may have some in-house accounting department who deals with it. But usually they look for independence, so they may have an auditor, especially where it's an active trust. So these are considered necessary to be for them to be considered reliable accounting records under the Act. You would have to ensure you have the documentation, and you should retain the documents for a minimum of 5 years where there's an express trust. If you fail to comply with this, of course, you can be tried and found liable under the summary offense of this Act, and you'd be fined $2,000. So the trustee is to ensure that they keep the accounting records, and these accounting records must include the assets and liabilities, all of the sales, purchases, and the like, and you should have some valuation prepared. So usually portfolios are valuated. So if I had shares in IBM, Facebook, and the like, my share value will not be the same as 6 months ago. It would be some changes in it 6 months later. So you should be able to at any time give the accuracy of the financial position of the trust and ensure that you have financial statements prepared. And what the period is we're going to use for us to have these accounts prepared. What period we're going to use? The
Anniversary date of the
right?
trust?
We could use the anniversary date, right? Or
Or
the
calendar
trustees could,
year?
yes, so we'll make sure it's within that period. So we have to remember now, we have to ensure, and it must be, once we've selected that date, what we must do. We should keep that period fixed, right?
Yes.
Yeah, so that period should be fixed. So it shouldn't be, this year it was in September, next year's June, the year after that's in January. It shouldn't be fluctuating like that unless you now, once you've set that period, you'd have to change it by making some change in the trust instrument. It has to be authorized. Okay, we are clear on the trustee's duty to account. Now we move into trust income. Who can help me with this section? This is a short little chapter we're doing.
I can go ahead.
Thank you.
Trust income. The income of the trust may be obtained from interest on deposits, dividends, rental income, and loans. These items will be calculated as the gross income. Capital gains, which are derived from the sale of trust property, are not classified as income for the purposes of the trust and are therefore not distributed to the income beneficiaries.
Okay, so we talked
Important.
about that, right?
Right.
The capital gain. So that's where the trust would have sold a house. That doesn't count as income for the income beneficiaries. Okay. So what we consider an income of the trust? Interest on deposits, dividends, rental income, and loans.
Yes.
Okay.
Mhm.
And they will be calculated as the gross income.
Right.
Because then what we'll take from that gross income?
Expenses.
Yes. Okay, go ahead.
Important considerations to be made in relation to the income from the trust properties are: 1, the power of the trustee to accumulate or retain income; 2, the extent to which income may be paid or used for the benefit of special beneficiaries with specific needs, example, physically or mentally challenged beneficiaries; 3, the beneficial interest which may be entitled to income; 4, the proper accounting of gross income and extent to which this income may be distributed to the relevant beneficiaries.
Okay,
In
so
calcul-
in us considering the income from the trust properties, we before we can distribute, we have to consider whether the trustee has the power to accumulate or retain income. So as much as there's income there, the trustees may have power to retain some of the income or to accumulate it. And the extent to which the income may be paid or used for the benefit of a special beneficiary with specific needs. So as much as we may have 10 beneficiaries, the special beneficiary may require more of the income. So we have to consider how much of that income would be paid towards this beneficiary, bearing in mind that the other beneficiaries don't have the needs that this beneficiary would have. We'd be considering who has interest, who has the beneficial interest, and who may be entitled to the income. And then after proper accounting of the gross income and extent to which the income may be distributed to the relevant beneficiary. So the extent to which it may be distributed will be hinged on the trustee's power to accumulate and retain, the extent of the income being paid to the special beneficiaries, and the beneficial interests which are entitled to such income. Okay, go ahead.
In calculating the gross income of the trust, it is important that the expenses attributable to income be deducted from the gross income to obtain the most accurate figure. Expenses attributable to income are defined as those of a recurrent nature, which are payable from the income subject to the provisions of the trust instrument.
So what may be
These
of a recurrent nature in income? What you think is income of a recurrent nature?
Rent, maybe?
Yes, yes. And what else?
Maintenance fees and stuff like that.
Right, but income, not fees.
Yes, maybe
Oh,
dividends.
income,
being
sorry.
paid in.
Yeah, yeah. So stuff like that. Okay, go ahead.
These expenses include, but are not limited to, recurring expenses in the administration of the trust and the protection of and preservation of the trust property, expenses for the management of the trust related to income generation, etc., and expenses related to the investment manager and other tasks related to income generation.
Okay, so we have recurring expenses, and you mentioned which was one of the recurring expenses, what you said it was,
Maintenance, you know?
right, maintenance fees. We may
Would
have,
insurances be considered recurring expenses as well?
so what the insurance would be though, what you would be paying,
Like insurance for on the property, on a home, for
right?
example.
So that's a recurring expense,
Uh,
but is that recurring expense for me as an income beneficiary?
Well, isn't it for the protection though?
It's
Of
for the
the
protection and
asset?
preservation of the trust property.
Mm-hmm.
And so what part of that I'm gonna do? What I'm paying insurance for?
I guess it would be more for the capital than for the income.
Yeah.
Right.
Right, but if, as with me as the income beneficiary, the protection and preservation of the trust property may be I wanna protect what? What I may pay for insurance wise as an income beneficiary on a trust,
Home
on a
insurance.
house. Hmm?
The home insurance, eh?
So I may pay the home insurance, eh?
Right.
To
Yeah.
preserve, right, so I may put, because
If
isn't the bank like an income beneficiary during the life of the house?
Yes.
Who
Because if
pays?
the asset is damaged, the customer would pay the home insurance, but if the
Right,
asset is damaged, then the bank would still be able to get their monies.
right, but in this instance, who would get the income if the home is damaged?
Oh,
The
yeah.
customer, the
Yes,
customer
right.
would get the check, but it would still be made out to the bank because if the customer, for example, doesn't want to continue, let's just say the home was for some reason underinsured,
Right,
and it's not going to be enough to build the home back, then they would be able to pay the bank out in lump fee because the bank would be lost payee. So they'd be able to pay the bank
right,
out and just pay the remaining balance.
but in this instance, we want to leave the house in place, so what will happen with that fund um from the loss, the insurance? They would use that to rebuild the house, eh?
Or be placed as an asset to the trust, the actual fund.
Right, so then it's now back to capital, isn't it?
Yes.
Right. Yeah.
Right, so you think they should be paying the insurance?
I kind of feel like it's a toss up because if you don't pay the insurance and something happens, then you don't get any income. But then if you do pay the insurance and nothing happens, then it just keeps like preserving the capital for the person who will eventually get it.
Right, but we have to protect and preserve the trust property in the meantime, eh?
Right.
So it may be a toss up, like you say, between the two. Who really should hold this expense? Who should hold this bag here?
I think the person, the capital, who gets the capital? Because
Because
at the
it
end of
looks
the day, you would want to make sure that everything stays intact so that you would be able to get something when this person passes away.
right. So we'd want to ensure, so we may, in the instant that the capital beneficiaries are not generating enough income from their capital, Because most of it go into income, we may have to say the income beneficiary may be responsible for insurance to ensure that the property is protected and preserved for them to receive income and for us to continue to preserve what is for us as remainder money. So that may be a little gray area there, and we may have to intervene as trustees to say, no, this may be something that is for the income beneficiaries to pay. Yes?
So would there be an instance where it can be split between both parties?
So we may approach them from that angle as well, because we'd have to toss it up to say now who really is going to benefit. But in the end, both parties would benefit, won't they?
Right.
Yes.
So it may be fair for both of them to share the expenses. And then they would have expenses for the management of the trust related to the income generation. So that's where you have it with stockholders, or you have it with portfolio managers. You'll be responsible for their fees that are generated as a result of that. Investment managers and other tasks related to income generation. So you would be responsible to pay those things as expenses, yes?
Okay.
Okay, let's continue.
The payment of expenses may be made from income or capital and may be directed by the terms of the trust law, or the trustee act as the facts dictate. Inherent in the power to make payments from income or capital in the trust fund is the discretion that the trustees have to decide from which account expenses will be charged or paid. Excuse me. Trustees may either accumulate or retain income that has not been paid up. The trust instrument would often direct whether trustees have the power to pay or to accumulate in certain circumstances. Any decision to accumulate whole income and invest it accordingly should be documented by the trustees and is often governed by the power to accumulate in the trust instrument, the time period for the trust or power, which ought not to be excessive, and whether the trustees decide to exercise the power. There must be a specific power to accumulate within the trust instrument in order for the trustee to retain income in the trust. The net income of a trust is normally calculated at the end of the trust accounting period, which gives the trustee an accurate account of the income of the trust.
Okay, so we have what we just talked about, payment of the expenses, eh? And what
Right.
happens with what we say, who have the discretion to decide from which account expenses will be
Trust.
charged? Okay, so the trustees will now decide who really should pay this for this insurance, eh? Whether this expense should come from income or capital. It may be directed by the terms of the trust, or it may be directed by trust law or by the trustee act as the facts dictate. But the power to make payments from income or capital in the trust fund is the discretion that the trustees have to decide from which account these expenses will be charged or paid. Again, the trustees can accumulate or retain income that is not being paid out. But the instrument usually direct whether the trustees have that power to pay or accumulate in certain circumstances. In any event, if they decide to accumulate, they should document it. And how do you document it? How we document what we're gonna do.
Through minutes.
Yeah, so we document it by minutes. So that's how we'd be able to trace what happened, or if somebody needs to question us, because we have to keep records, eh? So it should be documented, and at the time for you exercising this power should not be excessive. but there should be a specific power in the trust instrument to accumulate in order for you to, as a trustee, to retain income. So it should be as of one of the powers you have specifically included in your trust instrument. So the net income of a trust is normally calculated at the end of the trust accounting period. And what we say the trust accounting period is?
It could be determined at the outset or at the anniversary of the trust, but I guess usually annually.
Yes, thank you. So at the end of the trust, and it gives them an accurate account of the income in the trust. Any questions on trust income? Okay. Let's go to capital. We coming home. Who's gonna help us with capital? Okay, Leah, Lowe, and Miss Stubbs already did it. So we only have Miss Francis and Miss Sands to help us out now. Y'all could split it if you want to, or
Trust capital may be distributed to the beneficiaries named in a fixed interest trust or those whom the trustees exercise their discretion to distribute in a discretionary trust. Capital will often be distributed to those beneficiaries entitled after the expenses related to the capital have been paid. Expenses related to the protection and preservation of the capital in the trust fund are known as capital expenses and may include those expenses which apply to the trust generally or is considered capital expenditure on the trust assets. The capital expenses may be the principal of mortgage payments on trust property, substantial improvements to fixed assets such as land or buildings, and professional brokerage fees for certain stock transactions. In order to protect the interests of the beneficiaries, trustees will often take into consideration the time in which the beneficiaries will obtain the capital. Excuse me. And change such time if expedient necessary and the amount of the distribution to be made. With regard to the capital in the trust, trustees must take into consideration the advancement or appropriation to be made.
okay, hold on 1 second then now. So the trust capital may be distributed to beneficiaries named in a fixed interest trust or those, what's the difference with what we were talking about in the, for the income beneficiaries as compared in the express trust as compared to this fixed interest trust? What's the difference we have here already? Do we have, in the fixed interest trust, do we have discretion?
No.
No, so it
We
tells
would
you
leave that out.
what is to be paid, eh?
Yes.
Right. And then it can, or to those whom the trustees exercise their discretion to distribute in a discretionary trust. So these beneficiaries would receive this income after expenses related to the capital have been paid. So these expenses are called capital expenses, and they usually include principal of mortgage payments on trust property. So that's the house they still owe the bank. Substantial improvement to fixed assets, such as land or buildings. So we may improve the land or we may improve on the building, and brokerage fees for certain stock transactions. So where there's stocks, that's a capital of the trust, and the brokerage fees associated there too would be now an expense for the capital beneficiary. So the trustees take into account the consideration, into consideration the time in which beneficiaries will obtain capital And they can change that time if it is expedient or necessary, and the amount of the distribution to be made, because they have to take into consideration advancement or appropriation to be made to these beneficiaries. So we'll now look at what is advancement and what is appropriation as it pertains to these capital beneficiaries, because advancement or appropriation only takes place where there is what? We say we can appropriate a part of the trust assets, eh? Yes?
Yes.
And we may be able to advance a portion of it. So we have a discretion to do that in some instances. But it is only, these two only take place where there is what? Who would get advancement or appropriation?
The capital beneficiary?
In advancement, appropriation can be done for,
I guess the income beneficiary?
yes.
The
Okay,
income.
so let's continue. And now it becomes interesting. Go ahead. Thank you. Well, I guess, Ms. Sanj, you just finish off advancement and we can go to Ms. Francis thereafter.
Advancement is any large payment or distribution of capital to make some long-term or lasting provision for a beneficiary of the trust. Example, buying a house or professional practice for a beneficiary to live or carry out a trade or profession. The advancement must be the benefit of the capital beneficiary only.
Okay, so the advancement is a large payment or distribution of capital. It's not of income. And it's to make a long-term or lasting provision for a beneficiary of a house. So it can be for them to purchase a house or for them to open their practice. They may be a doctor or an architect, an engineer, a lawyer, and you can now advance a portion of the capital for this purpose. It is only for the capital beneficiary. Okay? Advancement only applies to the capital beneficiary. Okay, let's continue, Ms. Francis.
Okay. The trustee is prohibited from benefiting from the advancement in any way or benefiting another person other than the proper beneficiary. The operative word is benefit, and the trustee, as a general rule, must ensure that the advancement is for the benefit of the beneficiary, notwithstanding the fact that there is no real or specific need for the advancement.
Okay,
trustee
so
may
it doesn't have to be a need, real or specific, for the trustee to advance a portion of the capital for the beneficiary. They cannot benefit from the advancement, so they shouldn't get any quid pro quo from them advancing these funds to the beneficiary. But it is for the benefit of the beneficiary. So you can, as a trustee, decide, you know, something. This beneficiary is coming of age or they've just completed college. I think we'll advance them some capital so they can set up a business, or we'll advance them capital so they can get a home. But it doesn't have to be a need as such, but it's just the trustee looking at the beneficiary as a whole and using their discretion to help the beneficiary. Okay? Go ahead.
The trustee may also exercise a power of advancement to allow trust property to be held on a new trust to be advanced for the benefit of the capital beneficiary. These settled advances may be made if the beneficiary is sui juris, where an outright payment may be made, where the trust instrument allows, or on the creation of a new trust. The trustees of the original trust settlement may also be the trustees for the new trust settlement, although not required.
Okay, so the trustee may exercise the power of the advancement to allow the trust property to be held on a new trust to be advanced for the benefit of the capital beneficiary. So this is where the beneficiary is sui juris, and an outright payment may be made where the trust instrument allows on the creation of a new trust. So where the beneficiary may be entitled to a certain amount. So they have, where this beneficiary on their 18th birthday is entitled to 50% of the trust corpus or the trust property as a whole, they can now advance the trust property and create a new trust on behalf of this beneficiary, because now they are entitled, they're outright entitled to this trust property. And they may be, the trustees may be trustees of the new trust, although they don't have to be. They may, somebody else may be the trustees of the new trust for the beneficiary where the advancement has now created the new trust. Any questions? Okay, let's go to appropriation.
Appropriation is defined as the trustee's action in appropriating part of the trust asset for a specific purpose. The beneficiaries of the appropriated fund have rights only in such fund and have no interest in the non-appropriated fund and vice versa. The power to appropriate may be contained within the trust instrument, or the trust may direct appropriation specifically depending upon the terms of the trust. The consent of the beneficiaries is required for the power of appropriation to be exercised, but is not required where there is direct appropriation by the trust instrument.
Okay, so when we appropriate a portion, a part of the trust assets for a specific purpose, the beneficiaries of that appropriated fund have the rights only in that fund, and they have no interest in the non-appropriated fund, vice versa. So either they'll have interest in the appropriated or the non-appropriated fund. It can be contained in the trust instrument, or the trust may direct appropriation specifically depending upon the terms of the trust. The consent of the beneficiaries is required for the power of appropriation to be exercised. What we said about that earlier. Where the wife wanted to sell a house. Can she appropriate that asset without the beneficiary's consent?
No, she has to consult with
Yeah.
them. But what if they're
Right.
minors?
So then whoever is now their guardian may now act on their behalf, or the trustee may now act in their stead, because that's what the purpose of the trustee is, to make that decision on their behalf. However, it can be included in the trust instrument. So in order to avoid that, the trustee and the settler may decide, something, if it's necessary and my wife needs it, we'll put this clause in here that she can appropriate any asset if it's for her benefit, where the income is not sufficient to provide for her. So they may just put it in the instrument to afford the life tenant the opportunity to be able to recover their income during their life, and they won't falter, because going to the beneficiaries, they may just tell you no outright. So they may that may be something they want to put in the instrument from the get-go to avoid anything like that happening in the future. So because the power of appropriation, if it's not included in the instrument, it needs the consent of the beneficiaries. It may be wise for them to include that as a part of the trust instrument, where they have life tenants who are depending on the income of the capital of the trust. Okay. So where you have life tenants, you may consider that I should put direct appropriation in there. The trustees have the power to appropriate the trust fund without the consent of the beneficiaries, where it's beneficial or necessary to benefit the life tenant. Is that clear?
Yes, thank you.
Okay. Let's go over our self-assessment questions then. Number one, the trustee has a general duty to blank for trust property. Where will find that answer?
At the beginning, right?
Page 79,
And what is that?
account for trust property.
Ouch.
Account for trust property, excellent. Number two, both the blank and blank require information on how the investments are made. Capital is accumulated, income is generated, and the trust is being administered and managed generally. Where we'll find that answer?
In the same paragraph.
In the
And what
paragraph,
is it?
income beneficiaries, life tenants, and capital beneficiaries, remainderment.
Okay. Okay, you put in the brackets in, okay. Number three, trust accounts often comprise the blank and represent the accounting of the income and capital within a trust and the decreases and increases to such income and capital for a specific period. Where we'll find that answer?
In the next paragraph.
And what is it?
Trust accounts often comprise capital and income.
Okay, the capital statement and income statement, right?
Yes.
Number four, the income of the trust fund may be obtained from blank, 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 and blank. These items will be calculated as the blank of the trust. Where we'll find this answer?
It's page 80, I guess.
And what is it?
Interest, is it interest on deposit, dividends, rental income, and loans?
Yes, so we find that right under the head and trust income, right?
Trust income, yes.
Okay. Number five, important considerations to be made in relation to the income from trust property are blank, 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 and blank. Where we'll find that answer?
In the numbered section following the first paragraph of trust income.
So they are numbered 1 to 4.
Right.
The power of the trustees to accumulate or retain income, extent to which income may be paid or used for the benefit of the special beneficiaries, the beneficial interest which may be entitled to income, and the proper accounting of gross income and extent to which this income may be distributed to the relevant beneficiaries. Number 7, expenses related to the protection and preservation of the capital in the trust fund are known as blank and may include those expenses which apply to the trust generally or is considered capital expenditure on the trust assets. We will find that answer.
On page 80, the paragraph before the last,
Okay, and what is it?
recurrent,
No. Let's go up under capital on the second paragraph.
oh, oh, okay.
What is it?
Capital expenses, sir?
Yes, capital expenses. Number 8, define advancement. Where we'll find the definition.
Page 81,
Okay,
second
what is
paragraph. Advancement is any large payment or distribution of capital to make some long-term or lasting provision for a beneficiary of the trust.
okay. Define appropriation. Which page we'll find that on?
82,
Mhm.
appropriation is defined as the trustee's action in apportioning part of the trust assets for a specific purpose.
Excellent. And number 10, the blank is required for the power of appropriation to be exercised, but it is not required where there's direct appropriation by the trust instrument. Where we'll find that answer?
Last paragraph, is it power to appropriate?
No. Would be looking for? Is the last
Consent
paragraph?
of the beneficiary.
Yes, consent of the beneficiaries. Excellent. Okay, so we have study resource list. We have sections 9, 24 to 26, 30, section 5, 30, section 8, 37 to 39, and 89 of the Trustee Act, 1998. We know the duties, the trustee's duty to account. What is the trustee's duty to account? They have a what?
They have a general duty to account for the trust property.
Okay, and what are the fundamental concepts of the trust accounting? What is the fundamental thing?
Having reliable accounting records that show capital statements and income statements.
Right, and we should have an accounting period, which is usually,
Yearly,
right, and we usually set it on what?
the onset of the trust.
Right, so they can be at the anniversary date or as a period where the trustees elect. And we should include, what we should include in our trust accounting. We should have a minimum period to keep the accounts. How long we should keep them?
5 years.
5 years.
Yes. What about the differences between income and capital and the calculations related to both? How do we deal with income? Where we obtain income from?
From the capital.
Where we retain income, where we get income from? The trust income to be paid to the income beneficiary. Where we get it from?
From the capital.
No, we get it from interest on deposits, dividends,
Dividends,
rental
dividends,
income, and
loans.
loans. Yes?
But wouldn't that be considered the capital?
No, we get it
That's-
from these things that come from the capital, but it's not from the capital. Because if you put, you get it from the capital, would that be right on an exam?
I guess you have to specifically say income generated from the capital.
And in particular, you would now give examples of where the income comes from.
The loan and the dividend and interest.
Right, so
Okay.
we have to say where the trust income comes from. Now, what about the capital? What do we do with the capital? How do we derive the capital? How do we deal with the income between the income and the capital and the calculations? How do we deal with that? What do we say?
Do you mean
Can
with
expenses be paid from both income and capital? How do we differentiate where the income and where the capital is? How is it calculated? How do we differentiate it?
expenses that are in particular that relates to the protection and preservation of the capital should be taken from the capital expenses?
Right, and who now directs where these payments will be made from? If we have income, where we pay the expenses from, income or capital, how do we determine where they'll be paid from?
By using the Trustee Act,
Or,
trust law,
or,
terms of trust law, or the deed.
But who
Yeah,
has
the
the
instrument
inherent
itself.
power to make payments from income or capital in the trust fund?
Trustees.
The trustees?
Trustees. They'll decide which account expenses will be paid from, or charged. Yeah?
Yes.
When do we usually calculate the net income of a trust?
At the end of every year?
But what year?
Oh, sorry, at the, what do you
Counting
say?
period?
The accounting period, yes. And what is usually considered capital expenses?
The trust property?
What trust property? Expenses, what are considered capital expenses? Give me examples.
Capital expenses.
Principals are mortgage
Home
payments,
insurance,
Mhm.
payments, loan payments,
brokerage fees for
maintenance.
stocks.
Yes. And substantial improvements,
Right.
Excellent. Do we have
Brokerage
any
fees.
questions on this chapter? Is it clear?
Yes, I think so.
It's clear? Okay, so that wasn't a big chapter. Next week, we don't have a big chapter anyway. But if you read over it, it will help us so you can have questions prepared if you have any, if you need any clarity, okay?
Okay.
Okay. All right, so if you have no further questions for me?
Not
No.
yet.
Okay. Well, hopefully, once you do another read over, you'll be able to understand the chapter. We'll go over it in our class next week, God's willing. We'll just do a quick review, so let's be prepared for our review and move on to Unit 11.
Okay.
Thank you so
Okay.
much.
Thank you.
Thank you.
Enjoy the rest of
you.
your day and your weekend. Be safe.
You too.
Bye,
Bye.
everyone.
Thank you. Bye.